Hey, it's Michael Saul, but everybody calls me Tiny, and this video is You Gotta Be Kidding Me. Market analysis for the week of January 9th, 2017. I also have three brand new stocks for you to watch. Now, of course, what does the title mean? Well, the Dow comes a mere few ticks from hitting 20,000 on Friday, the 6th of January. It went to 19,999.63. I mean, come on. Come on. You can't even ticket a fraction, less than half of a point to get there. So if you look at this pattern here, it is actually a bullish pattern. It's a small base. It's not a huge one. Buying breakouts can be definitely a little dangerous, especially when we are extended like this. And yes, we are extended. I am not looking for a new bear market. I am not looking for a huge correction just yet. But buying breakouts can definitely test one's will when you are up. This is actually a bullish pattern because it is a consolidation after an impulse higher. But again, when you buy this above 20,000, I mean, I've been saying it for weeks. Is everybody just sitting there saying, okay, at 20,000, now I'm going to buy? So could it lead to one of the biggest traps in history? Or I read an article, I think it was yesterday, that said, oh, the Dow breakout will be the biggest trap in the history of the market. Okay, I don't know. All right, you know what? Maybe it will. But here's what is most important, and here's information that you can actually use. If you're looking to get on board the breakout and you're looking for another leg, just make sure you know your uncle point. Okay, with a pattern like this, it's pretty easy to identify it. It's not easy to trade or anything like that. I love the gurus that come out and tell you how easy it is to trade. No, it's not, but it is easy to put your uncle point. So if you're looking to buy a breakout here on this consolidation, then if it comes back down inside, you can either just pitch it, or you can use the bottom of the pattern, which I would go even a little bit. I'd go down to this low at that point, and then pitch it there. All right. Now, of course, this is a more conservative, even though it looks like, oh, well, that's more points. Right, but it's still a more conservative stop. An aggressive stop is it breaks out. If it doesn't hold that breakout and comes back down, I'm out. And it's aggressive because you are more likely to then take the next breakout again and do it again, and perhaps take it again and do it again. Now, I don't know how many times you would do it until you look for a different pattern, but aggressive traders have been known to take patterns multiple times. There are definitely some false starts throughout the history of the market moving. So who's saying that this can't be another one of those if indeed it does break out? If you're biased to the short side, or at least leaning to the short side. I don't know how you can be biased to the short side when we're at all-time highs, but whatever I teach, so it's your money. Okay, but if you're tilted to the short side and looking at this as a potential trap, then you watch for the breakout, and then you would take a short as it came back down through 20,000. So if it popped up through 20,000, went a little bit, and then came back down, and again, you know where your stop is at that point. Okay, now I'm talking if you're day trading, if you're swing trading, whatever that is. It's not going to work on an intermediate term time frame, obviously, because that's something you're looking to just buy and hold, whether it's an investment, maybe your retirement. So I'm talking about a shorter time frame. Doesn't have to be day trading. It could be swing trading as well. All right, so that's what I'm looking at here on the Dow. I want to see what happens at 20,000. If you're leaning to this being a trap, and I can't blame you for that, okay? I can blame you if you're biased. I could wag my finger at you and go, really? Biased at all-time highs? But leaning towards the downside, I mean, like I just said before, who's buying a 20K? But I guess we'll see, because to me it looks like this should get the breakout. How far we go, of course, is anyone's guess. All right. So again, if you're leaning to the downside, wait for the break and then the failure back. If you're looking to get long and you have faith that this can go, continue to go further, and that they will buy into 20 grand, then you look to get on board with either an aggressive stop, not right back down below 20,000 as a stop. You got to give it a little bit of wiggle room. Maybe you put the middle of the pattern. Maybe you put it 20% down into the pattern. And then if you're more conservative, you wait for the pattern to completely fail. Now, of course, because it's more points, risk waiting for the conservative way, you just adjust your size. Now, you may not be trading the Dow itself, either with options or with futures. Maybe you're trading some stocks that have a good beta, that move with the Dow, right? One of the Dow 30. Okay, so, I mean, you could look at them and pick a stock, whatever you want to do. All right, let's grab the rest of the indices. The S&P 500, nice start to the year. Didn't quite get to a new high, but looks like it's going to happen. The Qs did hit a new all-time high after hitting it late in 16. Hit another new all-time high. Nice stretch here. Go over some individual stocks. The Russell, I mean, this isn't bearish. It's a divergence that it didn't hit the new highs, but I mean, this pattern is still nothing to just look at and go, oh, this is a bearish pattern. Really? I don't see it as a bearish pattern. It looks like a bull flag to me. Mid caps, similar. All right, let's look at some individual stocks. I mean, Amazon had been lagging. Nice end of the week last week. Nice ripper up. Apple. Okay, maybe not exactly a ripper, but nice action. The Facebook, which was bearish. I mean, under the 200-day moving average in a consolidation, said, nah, we're going to go higher instead. Nice push up there. Okay, what about Alphabet? Or as I like to say, the Google. Nice push higher here. How about some banks? They've been strong. And, I mean, this is not bearish. Oh, it didn't hit a new high. Well, it's consolidating here. And I'm going to give you a hint. I have 3 stocks today to look at that are all in patterns similar to this. They're not financial stocks, but, I mean, yeah, they're not at all-time highs, or they're not at even the recent highs. They're pulling back a little bit, but not by much. And there's certainly no technical damage here. Citigroup. How about like a Northern Trust? Yeah, just powerful. Like a Zions. Bank of New York. I mean, these are all looking like nice consolidations. And why I love these patterns is you know where you're wrong pretty quickly. Just like I talked about the Dow. It's the same thing with these types of patterns. If they break and you get on board and then they come back, now on something like this where it's more like a pennant, not a flat consolidation, and it's a tight range, then you can still be aggressive and keep a stop underneath it. Okay, you don't have to just wait for a break to come back and then stop out. It's not like the Dow, which could have several hundred points until it comes out the other side. So this could still be an aggressive trade if you grab it and then it fails. And of course, the key to successful trading is always to manage the position once you put it on. Decide where to take profits, move stops, stuff like that. But this is way outside the scope of this video. All right, so there's some financials. Let's look at Goldman. Yeah, I mean, Goldman consolidating here. Semiconductors. Dun, dun, dun. Yeah, they're lagging a little bit. Thank you, NVIDIA, which had a monster run and is now consolidating here. Intel is lagging a little bit because it's not up here at the highs, but it's consolidating as well. How about the biotechs? And then we're going to look at gold too. Yeah, biotech's on a nice bounce here. You got stocks like, yeah, Gilead not really doing great, but trying to put a little base in there. And look at like a Biogen here. Is it Gilead or Gilead? I don't know, but whatever it is, it's GILD. How about that? How about the IBB, the NASDAQ? NASDAQ Index Fund, the NASDAQ ETF, NASDAQ Biotech ETF. Okay, there we go. All right, what else are we looking at? How about, why did I put the wrong symbol there? Stuff like Caterpillar and John Deere. Look at John Deere. Nice move here. Oh, Netflix, back to the techie space. Tesla. Now, back to Apple, in case you didn't see the news, Apple did have news about Tim Cook's salary being cut, or compensation, sorry, being cut. Maybe it was salary, I don't know, but it's that I've just call it comp, and that they're seeing some slowdown, but we'll see what happens with that. Okay, that was I read that over the weekend, but let's see what happens with that. Let's see how the market reacts to that before we get all crazy about it. So that was announced, Friday during the day, and the market Apple kind of shrugged it off. So it's not. Looks like it's headed to high. So maybe there'll be some fallout in the week, but I doubt it. I think right here the Dow is gonna go to new highs. Before we get there, quick look at gold though. Sorry, forgot about that. So gold is on the bounce, but this still looks corrective to me. The miners look better. I talked about that a couple of weeks ago. Miners do look better, but for now, it still looks corrective. And here's oil using the USO. It's still just sloppy here. All right, so now back to the Dow. So I think we're going to try to go higher here. And I usually don't like focusing on the Dow. I usually like focusing on the S&P, but the 20,000 number is such a talked about number here. We also have some seasonal trends and anticipation of market gains / losses coming up. If you're on my email list at attackthemarkets.com, I send an email, and I'm going to talk about that because Monday is officially the 5th day of the year. So it's a good idea to get on the mailing list and hear what I have to say about that. So there are predictors based on the first 5 days, believe it or not. Again, I don't hold a ton of weight in them, and I don't make my decisions based on that, but I do use it as a background indicator because the numbers just don't lie. Anyway, get on the email list and you'll discover more about that. So that's what I'm looking at this week. I'm looking for the Dow to move higher, and I want to see if it sticks on the breakout or, like I said earlier, if it fails. 3 stocks to watch for this week. Here they are. 2 in the education group. DeVry. Remember I talked about how I had 3 of these patterns that I showed you on Bank of America? Well, here's one. DeVry. Nice push out of a base in November. Consolidation. Let's see if it continues. Grand Canyon Education. Lope. Not as tight as DeVry, but setting up here. So maybe it wants to come out of this little coil, inside a coil, but you always have to pay attention because maybe it doesn't clear this trend line. But if it does, this looks like it can go up to new highs. And then here's one that's pollution and treatment. What is it? What is the correct sector? So I don't. Yeah, pollution and treatment controls is what I was going to say. Keko Environmental. Okay, another consolidation here. Lower priced. Any questions? Tiny at attackthemarkets.com. Have a great trading week. I'll talk to you in next week's video.